forecasting very easily. So I'm taking this opportunity to come into this semester's class for financial management. They have said we are not going to be waiting for the others. They will be able to join us on the way. So in that case, I will be able to take you through the financial management, and it is one of the interesting areas which we want to learn. So the first thing that I normally want the students to learn is about the content, right? What will be the content of the areas that you're going to be covering? Number one, I'm going to be taking you through the time value of money, time value of the money. When you look at the time value of money, we have to be having only two issues there. Okay? The time value of money, we should be having only two scenarios there. And I know the scenarios you've been facing through. We normally look at the determination. We normally talk about the determination of future values. The determination of the future values. And then we normally look at the determination of present values. The determination of the present values. How are we going to be getting the future value? Yeah, if you want to do the future value, we know that this is something called compounding. Counting. Then here, we normally do something called discounting, right? Discounting. Now, I know very well that we have been trading. Maybe, for example, we have been trading with let me talk about with the financial institutions within the country. And in most cases, we have to be having certain figures right now. We say we have a figure of 100,000. We have a figure of 100,000. And this figure of 100,000, we want to determine how much will be in 5 years. In most cases, these are insurance companies. They're going to be promising you that in the future you'll be having some millions and so on. So under the determination, and that one is normally applied through the compounding. We also have the determination of the present values. And it happens when we are dealing with the international markets. We will do something called the international financial derivatives. We have to be looking at in the future, for example, don't know what is happening now. Why is it hanging now? Why the screen hanging now? 1 minute. I have to be checking what is the problem. That is the only challenge of the internet. Welcome so much, Eric. I think you're getting me loud and clear.
Yes, I am.
So the reason as to why the screen is hanging, I cannot be able to determine, but let me check. I don't know the reasons, but I'm trying to change my gadgets and so on. But let's start proceed. That is what you're going to be looking on the time value of money. The time value of money. That is what you're going to be looking at. The compounding and discounting, and you're going to be having good times when you're dealing with the time value of money. Through this topic, we normally have something called the loan amortization schedule. I know you have been doing that, and in the loan amortization schedule, we have to be looking, and that is practical. That is what, when you are looking for the loan, that is what the banks will be calculating your loan. So the loan amortization schedule will be the last thing under the time value of money. Topic number two, we normally look at the valuation model. We are going to be looking on the valuation model. And when we are valuing, when we are going to be doing valuations, we normally value security. We normally value securities, and in most cases, we normally deal with three. Here we normally look at the valuation of bonds, right? The valuation of bonds. We normally have, and we are these are the securities which basically form the capital structure of the organizations. They normally form the capital structure of the organization. We also have the valuation of preference shares, the valuation of the preference shares. You know very well who are the preference shareholders. These are the people who are investing with the company X. They are investing with company X for the purpose of business of dividend and so on. Also interest, right? Interest is coming from the bond, sorry. Now, in this case now, we let us look at the valuation of preference shares. The valuation of preference shares. The valuation of preference shares. Now, not the preference shares, but the ordinary shares, sorry. The valuation of ordinary shares. Now, you know who are the ordinary shareholders. These are the owners of the organization. When we value these securities, we want to know what is the value of the fund? What is the value of company X, right? You present a company, right? You have continued developing the product and so on and so forth. Now, we want to look on the capital structure of the organization. These are the key things which normally finances the organizations. You know that these ones are going to be giving new capital to expand the businesses. When you look on the valuation of the bonds, bonds are going to be assisting you to get some interest. I know now most of us are targeting the infrastructure bonds, which the government will be able to issue, for example, in July. So these bonds are going to be, sometimes you normally talk about irredeemable bonds. Irredeemable bonds, they don't have a maturity period, right? You're going to be receiving the interest to the perpetuity. And that is what we're going to be discussing about it there. Now, we normally have redeemable bonds, and these are the ones that we normally invest. We want to know the period in which I'm going to be investing on these securities. And in most cases, these bonds which we are looking at, the irredeemable bonds, in some cases, they might be converted to other securities. You need to be given those options by whether you're dealing with the government or so. So they are going to be giving you the option. Upon the maturity period, can you be able to convert it maybe to ordinary shares and so on and so forth? So we can be able to enjoy that. Number three here, number three, number three, we are supposed to be looking on the cost of capital. The cost of capital. I know majority of you have done their undergraduate, right? And you have come across two things here. Now, when you want to analyze the capital structure of the organization, one, we want to know company X is financed by what, right? In that case, we only use WACC, right? This is what we are going to be looking at, the existing structure. We need to be doing the analysis of the existing structure of the company. What is the existing structure of the company? Then we have WMCC. WMCC. When you're looking at the WMCC now, this is different from WCC. The WMCC is normally using the historic. You're looking at the futuristic cost. So in this case now, when you're looking at it, we are going to be analyzing some concepts regarding to looking for the extra funds to finance new projects, right? To finance new projects. Where are we going to be using the funds? Now remember, when you're looking for the funds, you don't affect, it doesn't affect the capital structure. It doesn't affect the capital structure of the organization. It doesn't affect the capital structure of the company. We will be able to check on that. The other thing that I should be introducing you to here is let me talk about number 4. I'm looking for the right name, please. Let me look on the right name here. It is normally called the financial statement analysis. Financial statement analysis. So under the financial statement analysis, what are we going to be analyzing here? We are going to be analyzing and forecasting. You are going to be forecasting and analyzing here. And in this case, when you're looking on this topic here, is when you're going to be looking on the ratio analysis, right? Ratio analysis. There are the things that we have to be looking at there. We also have something in the examiners like it most. It is normally called the common size statement. Common size statement. Common size statements. Right? Whether it is vertical or horizontal. Then we are giving us for the last thing here, which is should be analyzing. It is normally called financial forecasting. The financial forecasting. Those are the most key things. These are the most key things which we start be looking under the financial statement analysis and forecasting. The other thing which I will be able to introduce to you here, and it is not new to you if you have done undergraduate. Note number 5, we normally talk about the introduction. And we are saying it is the introduction because there is time there. This is an introduction of capital budgeting decisions. Capital budgeting. Budgeting. Budgeting decisions. So what are we looking on the capital budgeting decisions? Very simple here. We are going to be looking at investment appraisal techniques. Investment appraisal techniques. Investment appraisal techniques. The second thing that we are going to be looking here is what we call the capital rationing. The capital rationing. Those are the two most important things which we need to be taking on under the introduction of the capital budgeting decisions. Number 6 here, right? Allow me just to be brief. We're going to be taking on the working capital management. Working capital management. Working capital management. Mimi ananiulizanga maneno ilianguka. Where am I standing? These topics are very interesting. I don't even know the mistakes which you are doing, causing you to fail the exams and making you not to see the other side of analysis or the other side of classes. Because now I know you're targeting the advanced level so that you can finalize on this. So under the working capital management, we are going to be looking on the types of the working capital, the importance, the objectives, and so on. We are going to also to be looking on the aspects of the inventory management under the working capital management. So the students who does the management accounting, they normally have an easy way of understanding of the working capital management. We will be able to make it easy for you. Now, the other thing here, and which I should be calling it topic number 7, and it should be the last topic because, and it should be my first topic now. This topic is basically called the introduction to portfolio analysis. Introduction to portfolio. Introduction to portfolio analysis. Portfolio analysis. When we look on the portfolio analysis, and these topics are calling introduction because they have a continuity under the advanced level. This is the topic number 1 at the advanced level. This is topic number 2, right? So they are there under the advanced levels, and those are the things which you need to be conversant with. Mostly, I know there are certain topics when you look on your content which are not included here, and it means they are theoretical part of it. So the theoretical part vile natumia theory mzuri huwa unajisomea pale, for example, Islamic finance, dividend decisions, and so on and so forth. Those are the theories which you should be factoring and considering to engage yourself and make it conversant to yourself. So the only thing I don't want to tell you that I will be able to sit down here and analyze Islamic finance. No. As long as I've given you the right notes, it is important for you to give a bit of time to study so that you can be able to see the other part of the yard, the other part of the yard. Now, I want to talk to this topic because it is independent of any other topic. The introduction to portfolio analysis. the introduction to portfolio analysis. I would like to start it. So let me start with the introduction. And I've looked at it. What is a portfolio analysis? What is a portfolio analysis? Ukiona nimeraa baraka ujue sasa najua vizuri, you'll be able to attend this. And also I want to finish up a topic. Ni kadogo sana. So that is why I like to start with it. So when we're looking at the introduction, the introduction to portfolio analysis, right? What comes in your mind? What comes in your mind? I'm just trying to learn this. It should be okay now. Okay. And I said earlier, you have to be downloading my loft app. My loft. When you put the introduction, we are calling it introduction to portfolio analysis. What is the introduction of this? Right? Introduction to portfolio analysis. Very simple. The portfolio itself, I know very well that today, majority of you are working hard to get a portfolio. And this portfolio we are looking at, we want to do certain investments. We need to do an investment X, we need to do an investment Y. And then you say, I don't want to put my money in one basket, right? I want to diversify the risk with the market still holds. So utaki kuweka pesa yako ikwame mahali. So in this case, that is where we are saying, when you're analyzing the portfolio theory, this is a combination. It is a combination of two, is a combination of assets, portfolios or securities. It is a combination of assets or securities with an objective, to number one, when are we diversifying? Why are we combining? Number one, you want to maximize the returns. You maximize the returns. You want to maximize the return. Then number two, right? You want to minimize the risk. I would like someone to take me through the dollar. The dollar account, the people are opening for the money market funds, right? I saw the minimum is 100,000, right? It tells me that it has the highest yield because it takes the highest returns and the highest risk in them. So those accounts, right? Which are guaranteeing you the highest returns, right? Which are guaranteeing you the highest return. They are not exposed to the risk. So in this case, when you're analyzing these two things here, because at the end of the day, when you're analyzing a portfolio theory, what are you looking at? You're looking for a return, right? A return, a portfolio return. So what is a portfolio return? What is a portfolio return? What is a portfolio return? Unakuja hapo unaniambia, it is a weighted. It is a weighted. It is a weighted average of the return. Weighted average of return. Average of return of assets in a portfolio. In a portfolio. E.g., what are we discussing about? This is a portfolio. It is a portfolio made up of two or more, right? Two assets. Let me talk about two assets. You cannot do a portfolio with only one portfolio now, right? We can't do with one. So it means you have to be analyzing the two assets. The two assets. For example, here, it means we have been talking about asset A and B. Asset A and B. Asset A and B. It doesn't mean that in an exam you're going to be getting asset A and B, right? It might be X and Y, M and N, P and Q, and so on and so forth. For example, but we need to have combination. So when we're looking at this, we are looking at a portfolio return. A portfolio return. You are investing. We already talk about the return of investment. How much am I going to be getting when I inject 200,000 in certain bonds and so on? That is what motivates. That's what normally motivates the investors. So when you're going to be doing your computation, the examiner will be asking, what is the return of the portfolio? The return of the portfolio. Now, for example, I'm going to be taking the weight of asset A. You multiply it by a return of asset A plus weight of B times the weight of B times the return of B, right? This is normally called the return of the portfolio. The return of portfolio, right? These are basically weights, right? In most cases, these weights of ours might be probabilities because they have to be determined in the future. They have to be telling you this is the expected, right? We have a 0% probability that the marriage will work. That is the probability, right? We have 0.4% that the investment that I'm working on, right? On the investment, because also the marriage is an investment. So what will be the return? What will be the return? What is the probability are you taking, right? To invest that part of yours, right? To say, hey, now I want to invest my heart. You are giving me the probability. You don't know whether it will work, right? You just be hopeful. Now, in that case, I want us to know to get, right, to get the expected return, to get the expected return of the portfolio, give the expected return of the portfolio, right? They normally call the expected return of the portfolio. The expected return of the portfolio. We normally get it how? We normally get it by taking the weight of A. We multiply by, right? We multiply it by the expected return of A plus the weight of B times the expected return of B. This is basically called the expected return. Is normally called the expected return of the portfolio. The expected return of the portfolio. So in this case, we want to get now this expected return. The expected return of A, right? What am I supposed to be using? The expected return of A, 90. You get the expected return of A, you normally take the summation of return A, you multiply by the probabilities. This is the summation. This is the summation, not the expected. The summation of return A. But in most cases, or in certain scenarios, the examiner might deny you the probabilities. The examiner might deny you the probabilities. And in that case, it means you don't need to panic. I can be able to say here, in absence of probabilities, to get the expected return of A, for example, you're going to be taking the summation of return A, you divide it by n, right? You divide it by n. Where we divide it by n, we say, in this case, we are going to be factoring something called sample size. So this is we say, this method is applicable when the sample size, when the sample size is greater than 30. When the sample size is greater than 30. When the sample size is greater than 30. That is when we are going to be using that. Right? That is when we are going to be using that. When the sample size is greater than 30, we normally apply this formula. Probability examiner ametunyima. Now, in order to talk about what we apply when the sample size is less than 30, we say, get the expected return of A. We don't take the summation of return A, we divide it by n minus 1, n minus 1, n minus 1, n minus 1. You now you can't see n minus 1. Yes. N minus 1, you can't see it. Let me do an adjustment. People go through. I think you'll see everything very, very okay. Now we are there now. And then under the n minus 1. So wakati examiner amekunyima kabisa, amekuambia now we have the probabilities. You say my probability ni hii, right? Hajakuambia what is the probability. Don't panic. Just let us look on the sample size. Are they greater than 30? If they are greater than 30, we take the summation of RA divided by N. The expected return of A is equal to the summation of return A divided by N minus 1. This is the most crucial part of the financial management and of portfolio theory and analysis. Now, from there, we have to be analyzing the risk involved. What is the risk involved? Risk involved. Unakuja hapo unaniambia, when we're looking on the risk now, kuna kitu ulisoma pale, for those who are coming from the foundation level, kuna kitu ulisoma inaitwa quantitative analysis. Quantitative analysis. Hata kama hujaisoma, umefanya ukiona some statistics 1 or 2 in the canvas, right? So in this case, now when you analyze the risk, right? How do you measure the risk under the portfolio? We say the portfolio risk, right? The portfolio risk is measured. The portfolio risk is measured using the standard deviation. Is normally measured using the standard deviation and coefficient and variation coefficient. Now, in this case, we say, right, the higher the standard deviation, the higher the standard deviation, the higher the standard deviation, the higher the risk. The higher the risk, the higher the risk, and vice versa. And the vice versa. So in this case, remember here, we are not analyzing a lot of things. We don't want to analyze a lot of things, right? We just want to be very, very precise. So in this case, hapo nakuja naambia mwalimu, to get the standard deviation of the portfolio. This is the standard deviation of the portfolio. Unakuja kujiangalia to get the standard deviation of the portfolio. Nilikuwa na credit growth. Nikuja naambia nataka na hii. Now, in this case, we are going to be taking the weights. Remember, I'm only using security A and B as a NB story. So in this case, I say the weight of A squared times, right, the variance of A. This side is the variance. The variance, I will analyze it about the standard deviation and so on. Plus the weight of B squared times the variance of B. Plus 2, the weight of A, weight of B, times covariance of the two securities. Covariance of A and B. This is normally called covariance. Hii tu ndio nakufunza advanced level. Hakuna nyingine, hakuna portfolio nyingine tofauti. Hii tu ndio nakufunza advanced level. Nimekufunza sahihi na kufunza advanced level. What you see, hata kama mkano bakiwa na power here, these are the variance. Right? These are basically weights, right? And that one is a covariance. Remember now that we say the standard deviation is the equal, it is a root of variance. Right? It is a root of variance. That is why you see, now we are squaring our variance. We square it. We square it. We square it. Because we rooted it. It's like dividing it by 2 now. That being said and done. That is being said and done. There are 2 things which I just want to know here. If the probabilities and so on, you know, if the probabilities are not provided if you are dealing with the sample size, this one could have divided it by n minus 1 if the sample size is less than 30, and then n and so on and so forth. But now, the most important thing is how do we normally get our value? We say, to get my variance, I'm going to be taking the summation. You remember kitambo sisi tulikuwa tumezoea hii, right? Hii ndio tulikuwa tumezoea hii. Hii ndio tulikuwa tumezoea. Hiyo ndio tulikuwa tumezoea. Pale tulifanya quantitative analysis. But hapa nakuja nakwambia, we are not dealing with x's, right? So in this case, hapa nakuja nasema, we are dealing with a return of a security A. It is expected return of A, right? Still be multiplied by the probabilities. Multiplied by the probabilities. This is what we are using now. We are dealing with the returns. hapa hakuna ma x and y. Sasa kuja hapo nakwambia now, to get a very simple thing, ndio nataka wewe ukue na hizi time. Unakuja unaambia mwalimu, to get the covariance of A and B. Tunachukua nini? To get the covariance of A and B, unakuja hapo unaniambia, can you be able to take a return of A minus the expected return of A, right? Return of B minus the expected return of B. Then you multiply it with that a probability. You multiply the probability. If the probability is not there, change the sample size. Change the sample sizes. I have already told you that. Or, right? If you want to get all of these, unakuja hapo na mwalimu, upate the covariance of A and B. Unachukua nini? Unakuja hapo unasema, nitachukua correlation coefficient of A and B, correlation coefficient of A and B, times the standard deviation of A times the standard deviation of B. Hii inaitwa correlation coefficient. Na imagine hii topic imeisha. Hauhitajiki formula zingine zaidi ya hapo. Correlation coefficient. Correlation coefficients. These are called standard deviations. Standard deviations. Mimi sifunzani vitu mingi relevant. Sifunzi vitu mingi relevant. That is what is being required for you to get that introduction to the portfolio theory. To the portfolio theories. So is it possible for us to do an illustration? Right? Is it possible for us to do an illustration like say here? We can be able to do 2 to 3 illustrations, then we close that topic. Then we ugange another topic. Uh, so, so let me deal with this straight away. So in this case now, let us go to the past papers. I told you to look for the past papers from my Loft app. So let me see the paper which I can be able to start with, which might be simple. Okay, you can start with this one. And you can see this topic guarantees you around 8 marks and so on. 8 marks and so on. Haya, someone read. Vamos ready. Can you read?
Job Nyaganya.
Continue.
Job Nyaganya plans to invest in 2 securities, security A and B. The returns on each security is dependent on the state of the economy as shown below. State of the economy, boom. Probability 0.4, return on security A, 27%, return on security B, 36%. On average, 0.5, 21%, 33%. Recession, 0.1, 18%, 31.5%. Required. Number 1, the standard deviation for security A and B. Number 2, the covariance between security A and B. Number 3, correlation of coefficient between security A and B.
Thank you so much. This question now inaingia iko mtihani and you'll be able to find it. Ukiwa na 8 marks can make you see a section that you have never seen before. So in this case, unakuja hapo unaniambia, if this is the kind of the question you are dealing with, then the examiner is asking you very simple questions to get the covariances, correlation, coefficient, and so on. The most important is to start and understanding your formulas. So unakuja hapo unaniambia, now this is your worksheet now, right? This is my worksheet. So swali ni ya December 2023, December 2023. December 2023, question number 2B. So the first requirement of this question, number one, the exam is asking us to get the standard deviation. To give a standard deviation for both security A and B. Security A and B. So in this case, hapo unakuja niambia get the standard deviation of security A. Unachukua nini? Unachukua the root. Yeah. For example, the summation of return A minus the total return of security A. You multiply by the probability. Multiply by the probability. So that nitakuwa guided by my formulas now. So in this case, hapo unakuja niambia what is our expected return? Nakuja nasema given expected return, I'm going to be taking the returns of A and multiply by the probability. Right? So do we have the returns? I say yes. The returns have already been provided by the examiner there. The first one is 27 times 0.40. Plus, right? 21 times 0.50. Plus, the third one will be 18 times 0.10. Allow me to do the expected return of B. Because also to support my charge. The first one will be 36 times 0.40. Plus, the other one will be 33 times 0.50. Then the third and the last one will be 31.5 times 0.10. Times 0.10. How much is this? So in this case, the first one now, it will be 27 times 0.4 plus 21 times 0.5 plus 18 times 0.1, getting around 23.1%. 23.1%. Then one will be 36 times 0.4 plus 33 times 0.5 plus 31.5 times 0.1, getting around 24.1. 94.1%. That's 4.1%. Those are the expected returns. That's what we answer. So nakuja hapo naangalia tuanze na standard deviation of A. Nakuja nasema wale kwanza tufanye variance. So tulisema tukipata variance tunairudi tunapata standard deviation. Nasema hivi. So in this case unakuja hapo unaniambia what are the returns? The returns ndizo hizi. Hata nimefanya kwa past paper. So the first one will be 27 minus 23.1. Squared, multiplied by the first probability. The second one will be 21 minus 23.1 squared, multiplied by 0.50. Then the third one will be 18 minus 23.1 times 0.1. Okay, let us now get our summations there. I start with the first one, 27 minus 23.1 squared. Then I multiply by 0.40, getting around 6.08. This one will be 21 minus 23.1 squared, and multiplied by 0.50, getting around 2.21. Then the third one will be 18 minus 23.1 squared, and multiplied by 0.1, getting around 2.6. So how much is the total here? So the total summation is 2.60 plus 2.21 plus 6.08, getting around 10.89. 10.89. Tunakuja kwa unafanya root yako. Nasema root of 10.89 ni ngapi? So the root of my answer, I get around 3.3. 3.3. That is the standard deviation for the security A. Nakuja kwa unafanya the same for B. Nakuja nasema the returns are already given in the question, but the expected returns tumepata hapa. So the second one will be 36 minus 4.1 multiplied by 0.4. So the other one will be 33 minus 4.1 multiplied by 0.50. Then the last one will be 1.5 minus 4.1 squared multiplied by 0.1. Tunaanza total ni ngapi? So tuanze na the first one, 36 minus 34.1 squared. I'm multiplying it with 0.40, getting around 1.44. The second one will be 33 minus 34.1 squared. I multiply it with 0.50, getting around 0.61. Then the sum is the last one. That 1.5 minus 34.1 squared. I multiply it with 0.10, getting 0.68. So 0.68 plus 0.61 plus 1.44, getting around 2.73. 2.73. So we are going to square the root of 2.73. What is the root of 2.73? So the root of the answer, getting around 1.64. Sasa kijana nilikuja hapa nakwambie, advised investor on the investment is supposed to be taken between the two, right? Unakuja hapa sasa unaangalia. You compare the standard deviation and you look at the one which has the less value, right? That is the one that the investor should be investing in. Hata unajua you cannot be able to take funds to an area you know you might be losing. You might be losing the funds. Now that is how you normally do it. That is how you do it. Unless you have a question, you will find the standard deviation of the two securities. That is how it is basically done. Then the other thing is about the covariance between security A and B, the covariance. The covariance. So unakuja hapo nakwambia vizuri sana. Ukiona the covariance of security A and B. Tulisema wewe uchukue return of security A minus the expected return of L. Unafunga hiyo bracket, unafungua number one, the return of B minus the expected return of B, then you multiply by what? With the probability. You multiply by the probability. You need to go to the first paper and say no. Because already the data are here, right? You have the returns and the expected returns, and then the probabilities are already displayed here. So nakuja hapo nasema waje tuanze na ya kwanza. 27 minus 23.1. Hiyo nafungia hapo. Then one will be 1 A kwanza. That minus 3.1. Then the last one will be 18 minus 23.1. Haya, tufungue za B hapa. Za B zitakuwa 36 minus 34.1. Nafunga hiyo bracket. 33 minus 34.1. Then the one will be 31.5 minus 34.1. Then here we multiply the probabilities. You use the FM ni rahisi sana. 0.40, 0.50, 0.10. Right? 0.10. Very simple. So let's talk to the first one now. That one, I'm students don't combine them. So divide by the kwanza. 27 minus 23.1. Unaandika answer yako hapa tu. 3.9. Unaandika mfano nyingine. Na 3 minus 4.1. Unapata 1.3. Times 3.9. Times 0.4. Hapo unapata 2.96. Haya. The one is 1 minus 23.1. Hapo unapata negative 2.1. Right? The one will be 33 minus 34.1. Getting negative 1.1 times negative 2.1 times 0.5. Getting at 1.16. 1.16. The last one will be 18 minus 23.1. Getting negative 5.1. Right. 5.1. That's 1.5 minus 34.1. Right? Times negative 5.1 times 0.1. Haya, hapa nimepata 1.33. What is the summation here? Well, I'm not struggling. 1.33 plus 1.16 plus 2.96. 2.96. I'm going to put a 5.44. That is the covariance of both security. The covariance of security A and B. This is the covariance. This is how you get it. That is how you will be able to get your covariances. I think you are able to see up to that point. Very good. So that is how you get the covariances. That is how you get the covariances. Then there is a last requirement. The examiner is asking you to compute what? Examiner anasema vizuri. The correlation of coefficient between security A and B. I'm not talking about the examiner. I have all the requirements. Right? I have all the requirements. Huyo anamwambia ni kitu rahisi sana. Na kumbuka vizuri, the point to be the covariance of A and B. Tunachukua na nini? Correlation coefficient of A and B times the standard deviation of A times the standard deviation of B. Let us make the correlation coefficient the subject to the formula. So in this case, the is here, you divide by the standard deviation of A times the standard deviation of B. These are these goes. So here we divide by the standard deviation of A and the standard deviation of motor B. To get the correlation coefficient of LB, okay, let's put covariance A and B. You divide it by the standard deviation of A and the standard deviation of B. Kuna kitu hatuna, tunasema hapana. That is why it is given 2 marks. The covariance of two securities, we put 5.45. Literally, they are not missing in exams. So the standard deviations, they are probably 3.3. Times 1.65. 1.65. 1.65. 1.65. Na utaipata examiner nakwambia vitu mingi kuliko hapo. So 5.45 divided by 3.3 times 1.65. Getting around 1. Our answer here is 1. Our answer is 1. Any question? That is how you do these questions. That is how you do the question. That is how you do the question. Any question? Any. Do you have the question now? That is how simple these questions are. Msiwe anguka financial management. How now? The afternoon paper, how will you fill it? Now, let's go to another question here. I want to hear Judy reading the question. There is a question here for April 2023. Let me check. Correct. April 2023, question number 3C. Please read for us.
The Magic Group portfolio comprises of Magic shares with an expected return of 10% and standard deviation of 20%, and Magic B shares with an expected return of 16% and standard deviation of 30%. The correlation between Magic A shares and Magic B shares is 0.4. The portfolio is comprised of 30% Magic A and 70% Magic B. Required the expected return of the portfolio, the standard deviation of the portfolio.
So umekutana examiner amekupea story. Na wewe story, wewe hujakuwa, you are not conversant with those stories. You like what the examiner has given you a table, right? Examiner anakupea a table. So this is what you does. Haya, unakuja hapo unasema nao, tuende kwa sheet yangu. Haya, iko namna hii. So examiner ananipea story mingi sana hapo. The first thing that I will do so that it gets easy for me is to do the analysis. So nakuja pale naambiwa Magic Group portfolio comprised of Magic A shares with an expected return of 10%. So we are being given the expected return. How will it be looking like? So to put an assets A, for example, and B, these are my portfolios. The portfolios are there. So the examiner is giving you the expected return. the expected return there. So you need to the expected return for A is 20%. And then we have the standard deviation. So the standard deviation of mine is how much? The standard deviation here, I can be able to see is 20%. The standard deviation is 20%, correct? Then we're also being told that Merge B shares with an expected return of 16%, so 16%, correct? Then on the other side, tunaambiwa the standard deviation of 40%. The standard deviation of 40%. The correlation between Merge A shares and Merge B shares is 0.4. So the correlation coefficient of A and B, we are giving it 0.4. 0.4 there. 0.4. The portfolio is comprised of 30% of A and 70% of B. Right? The portfolio is like now the examiner has given you some probabilities up there. So the probs there. Correct. So the probabilities it is 0.3 and 0.7. 0.3 and 0.7. Then examiner anakuja pale swali ya kwanza. The first question now, the examiner is asking you about the expected return. Right? Anakuuliza the expected return of the portfolio. Right? The expected return of the portfolios. The expected return of the portfolio. Right? Just 1 minute, please. So let's proceed, because now we were looking on the expected return of the portfolio. So the expected return of the portfolio. Unakuja hapo unaniambia, can you be able to take the weight of A? Right? Determine the weight of A, and the expected return of A, plus the weight of B, and the expected return of B. Remember now we are talking about the expected return of the portfolio. So in this case, remember the weight are already provided here. So the function will be 0.3 times the expected return we have 10 plus we have what? The weight of B is how much? 0.7 times the expected return, which is 16. How much is this? How much is this? How much is this? 0.3 times 10 plus 0.7 times 16. Getting around 14.2%. 14.2%. 14.2%. You can see how we are not struggling. They are just direct questions. The second one they're asking you about the standard deviation of the portfolio. The standard deviation of the portfolio, that is number one. Number two, we are looking on the standard deviation of the portfolio. So the standard deviation of the portfolio. So in this case, hapo unakuja waniambia mwalimu, ukienda standard deviation of the portfolio tunachukua the weight of something here. It's the weight of A plus times the variance of A plus the weight of B and the variance of B plus 2, the weight of A and weight of B, right? Weight of B times the variance of A and B. So I'm going to have not been given. So in this case, to the the standard deviations here, which we can just square. If you want to see that, we can square them of A and B. But now, the examiner has not given you the covariance of A and B. Remember, the important correlation coefficient of A and B, and the standard deviation of A, then the standard deviation of B. Now, so the combination coefficient in our case here, we will be given 0.4. We go 0.4, and the standard deviation of A And be able to see here, which is 0.2, that the standard deviation of B 0.4. 0.4. How much are you getting there? What is the correlation covariance? What is the covariance? 0.4 times 0.4 times 0.2. Getting around 0.03. Allow me to round off to get more places. Na umesema hiyo nao nakuja hapa nasema exam na mmaliza huyu. What is the root of all this? So we start with the weight is here. So it is 0.3 squared times body the body has as well as the deviation squared, right? 0.2 squared plus run weight is 0.7 squared times 0.4 squared. We did the standard deviation, we square plus 2 times the weight of A times the weight of B times the covariance. You can just feed your calculator with all these information. We start with 0.3 squared times 0.2 squared plus 0.7 squared times 0.4 squared plus 2 times 0.3 times 0.7 times 0.03. Then we get the root of it. We get around 0.31. 0.31. 0.31. That is how you do those questions. That is how you do that question. Very simple. You think you're not struggling? You're not struggling. And therefore, that is how you should be getting everything in your exams. Everything in those exams you're going to be doing now. I just want to do the last question, and therefore, once I do that question now, it is upon you now. It's upon you to do the other questions relating to whatever we are covering. For example, this one now. Carol should be reading for us now. Right? The question was tested on December 2022. Question number 2B.
The following information relates to security X and security Y returns for the year 2021. Do I need to read those probabilities?
No, because you can be able to see them.
Yeah, we can see them. So the question 1 is determine the expected returns for security X and security Y. Number 2 is determine the standard deviation for each security. Number 3 is determine the covariance between security X and security Y. Number 4 is determine the correlation coefficient between security X and security Y.
Thank you so much. I think the only area which I will be able to focus my attention to is about the return of Y, because this question is just direct to what we have done. I just do the first requirement, then the other 3 I give as an assignment. Because already we have done that, and therefore you can do the practice with the requirement 2, 3, and 4. So allow me to do the returns, because there is like a formula which they apply in there. And therefore you might be getting so much shocked in an exam. So this is what you normally do. The other things, nikisha kupea returns, hizo zingine you will be able to get. Now, the examiner is asking you about what is the expected return? The expected return now of X. It's called the summation of X multiplied by the probability. So in this case, for example, for X, you're going to be taking 30 times 0.10 plus, that one will be 20 times 0.20. The third one will be how much? 15 times 0.4. 15 times 0.4 plus, that one will be 10 times 0.2. Then the last one will be how much? Negative 50 times 0.10. That is when you get the expected return of x. Then when you look on the expected return of y, una formula nzuri pale wamenipea. For example, the first one, wamesema ni 12, right? The first one is 12. The other one will be how much? Right? The other one will be, the first thing is to get the returns first. So get the returns first using the formulas. So the return, the first one will be given is 12. The other one will be, tumeambiwa nini? 6. Wamesema ni 6 plus 0 times 20. Utapata hapo. The other one will be 6 plus 0.2 times 0.2 times, is it 2015? Example ametuonyesha pale. The other one will be 6 plus 0.2 times after 15 is 10. Alright, the other one will be 6 plus 0.2 times negative 50. Alright, take your calculator now. And we say, for example, this one you can see it is 4, this is 10. Right? This is 3, then it becomes 9. This is 2, and this is 8. Then this is how much? It repeats to be 0.2 times 0.2 times that to getting 10. So 6 minus 10, you get negative 4. To figure out to get the expected return, here's what you're supposed to do now. To get the expected return, the first one will be 12 times 0.10 plus 20 times 0.20 plus 15 times 0.4 plus this 15, no, 20. No, here is not 20, here is 10. I was just copying up there. This is not 15, this is 9. Now we go to 8 times 0.20 plus negative 4 times 0.10. 0.10. 0.10. So I know that you can be able to get this. You can be able to get this. So from there on, you can proceed with the questions. There is no any trick beyond that. That is what the trick with the examiner was using, so that you get the how to compute the expected return of y. And therefore, you can see I have already solved it for you. Then you'll be able to do, as you complete these questions, also go to April 2024. April 2024, there is a question there for the portfolio analysis. You do that questions again. You share. You need to share in our WhatsApp. Just share there. We see what you can do. We see what you can do. We see what you can do. Sina mengi ya leo nimefikisha hapo. Wale kuna swali. Sina mengi kwa leo. Any question?